Brad Williams, Frugal Finance, relative valuation models, definition, process, and types. What is a relative valuation model? A relative valuation model is a method used to estimate a company's value by comparing it to similar businesses or industry benchmarks. Instead of assessing a company's intrinsic worth through its expected future cash flows, this approach looks at how a firm stacks up against others in the same sector or market. By examining relative metrics such as earnings or market value, investors can gain an understanding of whether a company's stock is overvalued, undervalued, or fairly priced compared to its peers. Key takeaways: a relative valuation model compares a company's value to others in its industry to assess financial worth. Popular relative valuation metrics include the price-to-earnings ratio. Unlike absolute valuation models, which estimate intrinsic value without external comparisons, relative models use industry averages or competitors' metrics. Investors can use relative valuation models to determine if a stock is fairly priced compared to industry peers. How relative valuation models work? Relative valuation is based on comparing financial ratios or multiples, which reflects a company's market value relative to key financial metrics. Common ratios include the price-to-earnings ratio, price-to-sales ratio, price-to-cash flow, and others. These multiples are typically used to assess how a company's stock price relates to its earnings, sales, or cash flow in comparison to others in the same sector. For instance, the price-earning ratio is one of the most frequently used metrics. This ratio is calculated by dividing a company's share price by its earnings per share. A company with a high price-earning ratio may be seen as overvalued, while one with a low price-earnings ratio could be considered undervalued. Or in this particular case, underpriced. We're not valuing anything here, we're pricing. If we're going to look at value, we look at intrinsic. If we look at relative, it's called relative pricing, hence if it's underpriced. If the average price earnings in an industry is 10 times and a specific company is trading at 5 times, that company may be seen as relatively underpriced. Popular relative valuation ratios, price to earnings. Get this, when I say underpriced, what are we looking at? We're looking at price to earnings. We're looking at price to sales. We're looking at price to cash flow. So whether it's underpriced or overpriced, there's a big difference. That's the problem with the industry and journalists, is they don't understand the difference between pricing and value. Value is intrinsic. Pricing is relative. Price to earnings ratio measures a company's stock price relative to its earnings per share. A higher price earnings ratio suggests that the market is willing to pay more for each dollar of earnings. Now keep in mind, if the entire industry is overvalued, you're just looking at a problem that's magnifying itself. Or if the sector as a whole is undervalued, again, you're looking at a sector that could be problematic. You have to dig in, you have to turn over some rocks to determine what overpriced and underpriced actually looks like. So then you dig in and you do an intrinsic value and you do a comparison. Let's say you're doing something as simple as Walmart. You look at the intrinsic value of Walmart and then you compare that to the sector in terms of relative value, and you have to then determine whether or not it makes sense to invest in that particular company or sector or what have you. A great tool is regression analysis. I use regression analysis when I do relative valuation. That way you can compare apples to apples. Price to sales ratio compares a company's stock price to its total sales. This is especially used for companies with lower negative earnings. Price to cash flow focuses on cash flow rather than earnings, helping investors gauge a company's ability to generate cash from operations. Enterprise value to EBITDA compares a company's total enterprise value to its earnings before interest, taxes, depreciation, and amortization, useful for assessing companies with different capital structures. Relative versus absolute valuation models. The key difference between relative and absolute valuation models lies in their approach. Relative valuation uses external benchmarks such as industry averages or compares company data to assess a company's value. It compares multiples like PE or price to sales with similar firms to gauge whether the stock is fairly priced. Absolute valuation focuses solely on a company's fundamentals. This could also say intrinsic valuation. such as future cash flows or asset values, without considering external comparisons. It aims to determine the intrinsic worth of a company by estimating future earnings and discounting them to the present value. Relative valuation models are often used when investors want a quick snapshot of how a company compares to others, while absolute valuation models are better suited for understanding a company's long-term prospect based on its own financial performance. Examples of a relative valuation model: consider an example in the specialty retail industry. If the average price-earning ratio for this sector is 20 times earnings and Company A has a price earnings of 25 times, it is trading at a higher multiple than its peers, potentially indicating overpriced. If Company A's stock price is $50 and its earnings per share is $2, the price-earning ratio would be 25, calculated as 50 divided by 2. If the industry average is 20 times, this suggests that Company A's stock price is 10 times higher than it would be if it were trading at the industry average, which would price the stock at 40. This comparison may lead analysts to suggest that the stock is overpriced relative to its industry. Assumptions in relative valuation models. Relative valuation models assume that companies within the same industry or market segment operate under similar conditions and face comparable risks. This allows for meaningful comparisons between firms. However, the model also assumes that the companies being compared have similar business strategies, market conditions, and financial profiles, which may not always be the case. Limitations of relative valuation models. While relative valuation is a useful tool, it has its limitations. Market conditions. Companies in the same industry may still have very different operating strategies, customer bases, or growth prospects, which could make comparisons less accurate. Past financials. These models often rely on historic financial data, which may not accurately predict future performance, especially in industries undergoing rapid change or in times of economic volatility. Benchmarking. Finding an appropriate benchmark or industry average is critical. Incorrect comparisons can lead to misleading conclusions about a company's value. Conclusion: relative valuation models offer a way to assess a company's market value in the context of its industry peers. By comparing financial ratios such as the price earnings or the price to sales to industry averages, investors can determine if a company is priced fairly relative to its competitors. However, it's essential to consider the limitations and assumptions behind these models, as they depend heavily on accurate benchmarks and may not fully account for individual company differences. As with all investment tools, relative valuation is most effective when used in conjunction with other methods and comprehensive analysis. If you have any questions or concerns relative to relative valuation, comment. Brad Williams, Frugal Finance. Thanks for watching. Hope that helps. See you soon.